The Federal Reserve just did something it hasn't done in over 40 years, and nobody's talking about it. While everyone's watching stocks, a $34 trillion debt bomb is forcing the world's central banks into what historians will call the Great Repricing. Silver just crossed $113. Gold just hit $5,419. Not speculation, pattern recognition. Because this exact sequence has happened 3 times in modern history. And every single time, the people who saw it coming multiplied their wealth by 5 to 10 times. The people who didn't, they lost everything. Here's the thing. This isn't about market predictions or economic theory. This is about understanding a mechanical process that plays out the same way every single time a major reserve currency enters terminal decline. Stage 1. Massive debt accumulation during a period of perceived stability. Stage 2. Real interest rates turn negative as inflation outpaces monetary policy. Stage 3. Loss of confidence in paper assets begins with foreign holders. Stage 4. Rapid repricing of hard assets as capital flees monetary instruments. Stage 5. The new equilibrium, where precious metals reflect the true debasement that already happened. We're currently between Stage 3 and Stage 4, and I can prove it with 3 historical case studies that show this pattern with mathematical precision. Let me show you why this is inevitable. Weimar Germany, 1920 to 1923. Most people think hyperinflation happened overnight. Wrong. The Deutsche Mark was the second most held reserve currency in the world in 1919. Germany was an industrial powerhouse. Their bonds were considered safer than American treasuries. Then came the debt, war reparations from Versailles. 132 billion gold marks. Impossible to pay through taxation alone. Stage 1 complete. The Reichsbank started printing. But slowly at first. From 1919 to 1921, German citizens actually believed stability would return. The mark declined gradually, predictably, controlled. Real interest rates went negative in early 1921. Stage 2 complete. Here's where it gets interesting. Foreign holders began selling German bonds in late 1921. Not all at once, gradually. The international community still believed Germany would stabilize. But the smart money started moving. French investors, British banks, American speculators. They didn't sell because of hyperinflation. They sold because they recognized the pattern. A government unable to stop printing. A central bank unable to raise rates without destroying the economy. A population unwilling to accept austerity. Stage 3 complete. By mid-1922, the acceleration began. January 1922. $1 bought 192 marks. July 1922. 493 marks. By January 1923, 17,000 marks. But here's what they don't teach you in school. During this entire collapse, gold and silver prices in mark terms exploded. Not because precious metals became more valuable, because the mark became worthless. A single gold coin that cost 100 marks in 1918 cost 100 trillion marks by November 1923. Stage 4, the repricing. The people who held paper marks lost everything. A lifetime of savings gone in 18 months. The people who converted to gold, they survived, they thrived. They bought entire city blocks for a few ounces. This wasn't luck. This was pattern recognition. Let's jump forward. Argentina, 1989 to 1991. Different continent, different decade. Same exact pattern. The Austral was introduced in 1985 to replace the peso after hyperinflation. The government promised stability, fiscal discipline, a new era. Sound familiar? By 1987, Argentina's debt had reached critical mass, over $60 billion in foreign obligations. A government spending 30% more than it collected in taxes. Stage 1 complete. Real interest rates went negative in 1988 as inflation hit 175%, while nominal rates stayed capped at 80%. The government couldn't raise rates higher without triggering mass bankruptcies and unemployment. The same trap. Stage 2 complete. International investors started pulling capital in early 1989. The IMF began private discussions about a default. Foreign currency reserves dropped by 40% in 6 months. The exodus had begun. Stage 3 complete. Then came the acceleration. In January 1989, one Austral bought you a loaf of bread. By December, you needed 40,000 Australs for the same loaf. But gold? Gold priced in Australs went vertical. 1 ounce of gold cost 12,000 Australs in January 1989. By December 1989, 4 million Australs, a 330-fold increase in less than 12 months. Stage 4, the repricing. And once again, the pattern proved absolute. The people who held paper currency saw their savings evaporate. The people who held hard assets survived the transition. One more example, because 3 data points create an undeniable pattern. The Soviet Union, 1989 to 1992. Nobody expected it. The ruble was backed by the world's largest military, control over Eastern Europe, massive natural resources, nuclear weapons. Surely a superpower currency was safe? Wrong. The Soviet government had been running massive deficits for decades, hidden by state-controlled media and centralized planning. By 1989, the real debt load was over 90% of GDP. Impossible to service without printing, stage one complete. Real interest rates turned negative in 1990 as the government tried to maintain price controls while printing rubles to fund the military and social programs. Official inflation was 30%. Real inflation was over 200%. Stage two complete. Foreign holders of rubles began conversion in late 1990. East European nations, communist allies, even the satellite states started dumping Soviet currency for Deutsche Marks and dollars. The confidence was breaking. Stage three complete. When the Soviet Union officially collapsed in December 1991, the currency collapse accelerated beyond comprehension. January 1992, 170 rubles to the dollar. December 1992, 414 rubles to the dollar. By October 1994, over 3,000 rubles to the dollar. But here's the critical insight. Russians who converted savings to gold in 1990 preserved their wealth. 1 ounce of gold bought you 3 months of salary in 1990. By 1994, that same ounce bought you 3 years of salary. The repricing rewarded those who understood the pattern. Stage 4, complete. 3 different countries, 3 different political systems, 3 different decades. The exact same 5-stage pattern. Now, before we go further, let me be clear about something. I'm not a financial advisor. Nothing in this video constitutes investment advice. What I'm sharing is historical pattern analysis and economic data for educational purposes only. You should always do your own research and consult with qualified professionals before making any financial decisions. The precious metals market carries risks, including volatility and potential losses. Past performance doesn't guarantee future results. But understanding historical patterns, that's just being informed. And right now, being informed might be the most valuable thing you can do. Now let's apply this pattern to the United States, 2020 to 2026. Stage 1, massive debt accumulation during perceived stability. The U.S. national debt stands at $34 trillion. That's 120% of GDP, higher than any point in American history except the final year of World War II. But here's the difference. In 1945, America was the world's creditor nation with manufacturing dominance and a young population ready to work. In 2026, America is the world's largest debtor with declining industrial capacity and an aging population requiring ever-increasing entitlements. Total unfunded liabilities, when you include Social Security, Medicare, and Medicaid? Over $200 trillion. The government is spending nearly $2 trillion more than it collects, every single year, with no political will to cut spending or raise taxes meaningfully. This isn't theory. This is mathematics. Stage 1 complete. Stage 2. Real interest rates turn negative as inflation outpaces monetary policy. The Fed funds rate is currently around 4.5%. Official CPI inflation ran at 3.4% last year, but that's the manipulated number. Real inflation, using the methodology from 1980, closer to 10%, which means real interest rates are deeply negative. Savers are losing purchasing power. Bondholders are losing purchasing power. Anyone holding dollars is losing purchasing power. The Fed can't raise rates meaningfully without triggering a debt crisis. The government can't service $34 trillion at 8 or 9% rates. They're trapped. Stage 2 complete. Stage 3. Loss of confidence in paper assets begins with foreign holders. And this is where it gets really interesting, because this stage is happening right now. In real time, China has been dumping U.S. treasuries for 18 consecutive months. Their holdings dropped from over $1 trillion to $820 billion. Japan reduced their holdings by over $100 billion in the past year. These aren't minor adjustments. These are strategic repositionings by the 2 largest foreign holders of U.S. debt. Saudi Arabia just announced they're diversifying reserves away from dollar-denominated assets. The same Saudi Arabia that's maintained the petrodollar system since 1974. When your oldest ally starts diversifying, that's not noise, that's signal. The BRICS nations are actively working to create alternative payment systems. Russia settled oil transactions in yuan. India bought Russian oil in rupees. Brazil and China are trading in their own currencies. The de-dollarization isn't a conspiracy theory. It's documented policy. But here's the tell. Central bank gold purchases hit an all-time record in 2023, then broke that record again in 2024, then broke it again in 2025. China's official gold reserves increased by over 200 tons last year, and that's just what they report. Independent analysts estimate their actual accumulation is 3 to 4 times higher. Poland bought 100 tons. Singapore tripled their holdings. Turkey, India, Kazakhstan, Uzbekistan, Every major central bank is accumulating physical gold at unprecedented rates. They're not buying because gold pays dividends. They're buying because they recognize the pattern. Their economists studied Weimar. They studied Argentina. They studied the Soviet Union. They know what stage 3 looks like, and they're positioning accordingly. The smart money isn't retail investors watching YouTube videos. The smart money is sovereign wealth funds and central banks, and they're buying physical gold with both hands. Stage 3 is nearly complete. Look at the velocity. In Weimar, stage 3 lasted about 18 months from first foreign sales to mass exodus. In Argentina, it lasted 14 months. In the Soviet Union, about 16 months. The US started seeing significant foreign treasury dumping in mid-2024. We're now in late January 2026. That's approximately 19 months, right at the historical average for stage 3 duration, which means stage 4 acceleration could begin any time in the next 3 to 6 months, or it could begin tomorrow if a catalyst emerges. Which brings us to stage 4, rapid repricing of hard assets as capital flees monetary instruments. And this is where we are right now. Silver was $30.43 exactly 1 year ago. Today it's $113.77. That's a 274% increase in 12 months. Gold was around $2,700 last January. Today it hit $5,419. A 100% increase? These aren't normal market movements. This is the repricing. This is capital fleeing paper and seeking real assets. This is stage 4 beginning. And here's why it's going to accelerate. The silver market is tiny. Total above ground silver available for investment, around 2 billion ounces. At current prices, that's a $200 billion market. For context, Apple has a market cap of $3 trillion. The entire investable silver market is smaller than one tech company. Now imagine what happens when a fraction of global capital decides to flee bonds and chase hard assets. When pension funds allocate 1% to precious metals, when sovereign wealth funds increase their allocation from 5% to 10%. The mathematics are brutal. Every 1% of global bond markets that rotates into silver represents over $2 trillion chasing a $200 billion market. That's a 10-to-1 ratio. Supply and demand doesn't bend, it breaks. And when it breaks, you get Weimar. You get Argentina, you get the Soviet Union, you get the repricing that makes early movers wealthy and late movers destitute. Think about where you'd position yourself if you could see 6 months into the future. Would you hold bonds yielding 3% while inflation runs at 10? Would you hold cash that's losing purchasing power by the day? Or would you hold the one asset class that's preserved wealth through every single currency collapse in human history? I'm genuinely curious what most people are thinking right now. Drop a comment below. Are you seeing what I'm seeing? Or do you think this time is different? Because let me address that. The "this time is different" crowd. They always show up at this exact stage of the pattern. They said it in Weimar. We have the best engineers in the world. German industrial capacity will save us. It didn't. They said it in Argentina. We have natural resources. Agricultural exports will stabilize the currency. They didn't. They said it in the Soviet Union. We have nuclear weapons. Military power guarantees reserve currency status. It didn't. And now they're saying it in America. We have technology. We have the largest economy. We have the reserve currency. We have the strongest military. None of that matters when the mathematics break. None of that matters when confidence evaporates. None of that matters when the pattern reaches stage 4. The repricing doesn't care about your technology. It doesn't care about your GDP. It doesn't care about your military. It cares about one thing: supply and demand for real assets when paper assets become suspect. Here's another common objection. The government won't let it happen. Really? The Weimar government didn't want hyperinflation. The Argentine government didn't want currency collapse. The Soviet government didn't want the ruble to implode. But wanting something and being able to prevent it are two different things. Once you reach stage 3, once foreign holders start dumping, once the confidence breaks, the government's options narrow to nothing. They can't raise rates without triggering a debt spiral. They can't cut spending without political suicide. They can't increase taxes enough to close a $2 trillion deficit. They're trapped. And trapped governments always choose the same solution: print, which accelerates stage 4. One more objection. Gold and silver don't produce income. True, but neither do treasury bonds when real yields are negative. A bond paying 3% while inflation runs at 10% is losing you 7% per year. That's not income. That's guaranteed destruction of capital. At least gold and silver maintain purchasing power. At least they've historically repriced to reflect the debasement. At least they've survived every currency collapse in recorded history. So where does this go? If the pattern holds, and every historical precedent says it will, we're looking at silver hitting $150 within the next 12 months, $200 within 18 months, Gold pushing past 7,000 by late 2026, 8,000 by 2027. These aren't predictions. These are mathematical projections based on historical repricing multiples during stage 4 transitions. When the Weimar mark collapsed, gold repriced by a factor of 1 trillion. When the Austral collapsed, gold repriced by a factor of 330 in 12 months. When the ruble collapsed, gold repriced by a factor of 17 in 3 years. The dollar has been debased by approximately 98% since 1913. The current gold price of 5,400 reflects maybe half of that debasement. Full repricing to historical ratios puts gold between 8,000 and 12,000. Silver, with its industrial demand and supply deficit, could easily hit 200 to 300. But here's what most people miss. The repricing isn't smooth. It's not linear. It happens in violent, unpredictable surges. Silver went from $30 to $113 in 1 year. That's the kind of move that happens in stage 4. You get months of consolidation, then a massive spike, more consolidation, another massive spike. Each spike representing more capital fleeing paper and seeking real assets. Each spike representing more people recognizing the pattern. If you found this analysis valuable, if you want to understand how to position yourself for the next phase of this pattern, make sure you're subscribed. Because the next video breaks down the specific strategies that worked in Weimar, Argentina, and the Soviet Union. The exact timing indicators, the exact allocation percentages, the exact mistakes to avoid. This isn't generic advice. This is pattern-based positioning that's worked through every currency collapse in modern history. Hit that subscribe button, turn on notifications. Because stage 4 moves fast, and being late costs everything. Let me give you the practical framework. First, understand that this isn't about market timing. This is about pattern positioning. The pattern says we're in late stage 3, early stage 4, which means the bulk of the repricing is still ahead. Not half, not most. The bulk. In Argentina, 80% of the repricing happened in the final 6 months of stage 4. In Weimar, 90% happened in the final 8 months. The early movers got wealthy. The people who waited for confirmation got destroyed. Second, understand that diversification in a currency collapse is pointless. Diversifying between stocks, bonds, and real estate denominated in a collapsing currency is like rearranging deck chairs on the Titanic. Real diversification means holding assets that aren't denominated in the currency at all. In Weimar, people with diversified mark-denominated portfolios lost everything. Stocks went up in nominal terms. But a stock portfolio that went from 1,000 marks to 1 trillion marks still bought you nothing when bread cost 2 trillion. Real diversification meant holding assets outside the monetary system entirely. Third, understand that the government's response will be more printing. Always. Because it's the path of least resistance. Raising taxes triggers voter revolt. Cutting spending triggers beneficiary revolt. Defaulting triggers international crisis. But printing happens quietly. Digitally, with technical language that confuses the population. Quantitative easing. Liquidity operations. Emergency funding facilities. All euphemisms for the same thing. Creating currency units out of nothing. Which accelerates the debasement. Which accelerates the repricing. Fourth, understand the supply dynamics. The silver market is structurally different than gold. Silver has industrial demand that's growing exponentially. Solar panels, electric vehicles, 5G infrastructure, semiconductors, AI data centers. Every major technological trend of the next decade is silver intensive. Meanwhile, above-ground silver inventories have been declining for 8 consecutive years. We're mining around 850 million ounces per year, while industrial demand alone is over 900 million. Before you add investment demand, before you add monetary demand, before you add central bank demand that's just starting, the deficit is real. The supply shortage is measurable. And when investment demand floods into a market already running a structural deficit, prices don't rise linearly. They spike, they gap, they create shortages at any price. In late 2023, retail silver dealers ran out of inventory for weeks. Premiums hit $12 over spot, and that was before silver crossed $50. Imagine what happens at 150, at 200, at 300. So what does positioning look like? Physical metals, not paper contracts, not ETFs, not mining stocks, physical silver and gold that you control. Because in every historical collapse, paper promises failed. In Weimar, people with gold certificates got paid in worthless marks. The government simply printed the marks to settle the certificates. Technically fulfilled, practically worthless. In Argentina, people with commodity contracts got settled in worthless australs. Same mechanism. Legal but economically meaningless. In the Soviet Union, people with ruble-denominated accounts got destroyed. The numbers stayed the same. The value evaporated. The only thing that worked was physical possession. Gold coins, silver bars. held outside the banking system, outside the government's easy reach, outside the paper settlement mechanisms. This isn't about conspiracy theories. This is about understanding that in a currency collapse, the government's incentive is to preserve the system at the expense of savers, every time, without exception. Physical also means dealing with the reality of storage and security. You can't hold $1 million of silver in your apartment. 1,000 ounces of silver weighs over 60 pounds. 20,000 ounces is over 1,200 pounds. You need a plan. Safe deposit boxes for smaller amounts. Private vault services for larger amounts. Distributed storage across multiple locations. This isn't complicated, but it requires forethought. Because during the acceleration phase, when everyone's trying to buy, vault space disappears. Security services get overwhelmed. Shipping delays extend to months. How much? Historical precedent says 20 to 40% of liquid wealth in precious metals during stage 3, 50 to 70% during stage 4. We're transitioning between the two right now, which suggests building toward at least 30 to 40% allocation. For most people, that feels extreme. It should. Because most people don't understand the pattern. Most people haven't studied what happened in Weimar when 99% of the population held paper and lost everything. Or what happened in Argentina when the middle class evaporated in 18 months. Or what happened in the Soviet Union when lifetime savings became meaningless overnight. Is that aggressive? Yes. But every person who survived Weimar, Argentina, or the Soviet collapse wishes they'd been more aggressive earlier. Every memoir, every interview, every historical account says the same thing. I wish I'd converted more sooner. I thought I had time. I thought the government would fix it. I thought this time was different. They were wrong. And being wrong cost them everything. Being too early costs opportunity. Being too late costs everything. The allocation should scale with age and circumstances. If you're young with high income potential, 20 to 30% lets you rebuild if wrong while protecting if right. If you're near retirement with fixed income, 40 to 60% makes sense because you can't afford to be wrong. If you're managing generational wealth, 50 to 70% is conservative because preservation matters more than growth. These aren't random numbers. These are based on what worked historically for people in similar situations. What about timing the entry? The pattern says don't. Dollar cost averaging works in normal markets. This isn't a normal market. This is stage 3 transitioning to stage 4. In Argentina, people who dollar cost averaged through 1989 paid an average price that was 90% higher than people who bought aggressively in January, because the repricing accelerated faster than they could accumulate. In Weimar, people who waited for pullbacks missed the entire move because the pullbacks were measured in hours, not weeks. The pattern says, buy consistently but urgently. Build the position over weeks, not years. Over months, not decades. Because once stage 4 reaches full acceleration, the availability disappears before the price reflects scarcity. Dealers run out of inventory. Mints can't keep up with demand. Premiums explode to 20, 30, 40% over spot. At that point, you're not buying at market prices. You're buying at panic prices, and panic prices are always higher than pattern prices. What about timing? The pattern says stage 4 accelerates when one of 3 triggers hits. A major geopolitical event that shakes dollar confidence, a sudden spike in inflation that forces central bank action, or a sovereign debt crisis that reveals the true insolvency. We're watching for all 3. Any of them could be the catalyst that moves silver from 113 to 150 in weeks, not months, gold from 5,000 to 6,000 in a similar time frame. Here's the bottom line. Every single time a major reserve currency entered terminal decline, the pattern played out the same way. Stage 1, debt accumulation. Stage 2, negative real rates. Stage 3, foreign dumping. Stage 4, hard asset repricing. Stage 5, new equilibrium. We've completed stages 1 and 2. We're finishing stage 3. Stage 4 is beginning. The evidence is undeniable. Silver up 274% in 1 year. Gold up 100%. Central banks buying record amounts. Foreign holders dumping treasuries. Real yields deeply negative. Debt unsustainable. The question isn't whether the repricing will continue. The pattern says it will. The question is whether you'll position before or after the majority recognizes what's happening. Because once everyone sees it, once stage 4 reaches full acceleration, the premiums explode. The availability disappears. The opportunity closes. In Weimar, people who tried to buy gold in late 1922 paid massive premiums and still came out ahead. People who waited until 1923 couldn't find any at any price. This is pattern recognition. This is historical analysis. This is understanding that human nature and government incentives create predictable outcomes. And right now, every indicator is flashing the same signal. The repricing has started. Silver at 113. Gold at 5,400. And if the pattern holds, we're looking at $125 silver and $6,000 gold as just the next waypoint, not the destination. One final thought. I know this sounds extreme. I know it challenges everything you've been told about modern monetary policy and government stability, but so did Weimar until it happened. So did Argentina until it happened. So did the Soviet Union until it happened. The pattern doesn't care what you believe. It only cares about the mathematics of debt, debasement, and confidence. And right now, all three are pointing the same direction. Check the historical data yourself. Verify the debt numbers. Look at the central bank purchases. Watch the foreign treasury holdings. Calculate the real inflation rate. Then decide if this time is actually different. Or if we're just in the same pattern humanity has repeated dozens of times before. The great repricing isn't coming. It's here. The only question is whether you're positioned for it. What do you think? Am I missing something in this analysis? Is there a factor that makes this time genuinely different? Let me know in the comments. I read every single one. And if this video changed how you think about the current situation, share it with someone who needs to hear this message. Because the window for positioning is closing. And once stage 4 reaches full acceleration, being late means being left behind. The pattern is clear, the data is undeniable, the repricing has begun.